Hello everyone, this is Dr. Zaidi. Welcome to my YouTube channel ZTube. In this video, we are going to discuss the differences between absorption costing and variable costing. So what is absorption costing? Absorption costing is also known as full costing. Absorption costing is required by generally accepted accounting principle in the United States, right? And it's required by international financial reporting standards in many countries who follow the international financial reporting standards. So this is required because it is the external financial reporting requirement. So how is it different from variable costing, which is also known as a direct costing, also known as a marginal costing, also known as a contribution margin format income statement? Just like absorption costing is required for external reporting purposes, variable costing statements are required for internal financial reporting purposes. The management needs to know this information for decision making. The variable costing statement separates out the cost into variable and fixed costs for decision-making purposes, whereas absorption costing um, uh, separates out costs in terms of the manufacturing cost and the non-manufacturing or period cost. So in the absorption costing, all variable and fixed manufacturing costs are included as an inventoriable cost. Inventoriable cost is what? Something that ends up in the balance sheet as an inventory is an inventoriable cost. Whether it's a material cost, material is a material inventory, whether it's a work in process inventory, whether it's a finished goods inventory, anything that is inventoriable is considered as anything that is inventoriable cost is variable, and fixed manufacturing overhead cost should be included as the part of inventory in your balance sheet. And the fixed manufacturing overhead costs are also considered as a product cost, right? In absorption costing. In variable costing, fixed manufacturing overhead cost is not considered as a product cost. It is considered as a period cost. In the period, you incur that cost. Only and only variable manufacturing cost, whether it's a direct variable manufacturing cost or indirect variable manufacturing cost, that are included in the inventoriable cost. Okay, we exclude fixed manufacturing overhead cost because this is considered as an expense of the period. So here is a brief overview of that. If you see, there is absorption costing, and right hand side is a variable costing. So direct material is a variable cost. Okay, so it is included in the variable cost. It's also included in the absorption costing as a product cost. Direct labor is a variable cost, included in the variable costing statement as a product cost, included in absorption costing as a product cost. Variable manufacturing overhead cost is also variable and is included as a product cost in variable costing, and a product cost in absorption costing. However, that's where it differs in the fixed manufacturing overhead. Remember what I said. The fixed manufacturing overhead is considered as a period cost in variable costing. In the period you incur that cost, whereas the absorption costing records this cost as a product cost because it's a manufacturing related cost. GAAP requires that you record it as a product cost. So that's the difference between these two, where your inventoriable cost will differ in a variable costing statement and absorption costing statement. Okay, so here is the income statement. Absorption costing and variable costing. As I said earlier, absorption costing is a traditional format income statement. Variable costing is also known as a direct costing or a contribution margin format income statement. So here, your sales minus cost of goods sold is gross profit, minus operating expenses is your operating income. In variable costing, sales minus variable cost of goods sold is manufacturing margin, minus variable operating expenses is your contribution margin, and you subtract fixed cost to get operating income. Now, in the traditional or absorption costing statement, GAAP requires that you combine all manufacturing related costs together. So we combine variable and fixed cost of goods sold together. Variable cost of goods sold is your variable manufacturing cost, which is material because it varies with the number of units produced. Direct labor, which is also variable, and it's a manufacturing cost. It varies as you produce more or less unit. Also variable manufacturing overhead costs, such as utilities, it varies when you produce more or less unit. So this is all variable manufacturing cost is considered as a variable cost of goods sold, and fixed factory overhead or fixed manufacturing overhead, such as the depreciation on the factory building or the factory supervisory salary, is considered as a fixed cost of goods sold. Okay, so that's considered as a cost of goods sold, and they're combined together, all manufacturing costs, in the absorption costing statement. And all operating expenses, whether variable or fixed, are combined in the operating expenses in the absorption costing statement. Variable operating expenses are the sales commission is variable, the transportation cost is variable, so that can be included here. Fixed operating expenses could be president salary, CEO salary, the factory, not the factory, the head office depreciation, the head office rent, and taxes that can be considered as the fixed operating expenses. So that can be included together. All kind of a period cost or operating expenses can be added together, and all manufacturing costs will be added together. However, in variable costing statement, you include only the variable the variable manufacturing related cost as a variable cost of goods sold. So if you see here, material, labor, and overhead, variable overhead is included as a variable cost of goods sold. And then we also add variable operating expenses, and then in the variable cost of goods sold, and we subtract them from sales to come up with the contribution margin. So sales minus variable cost of goods sold and variable operating expenses is your contribution margin. And then we combine the fixed manufacturing overhead and the fixed operating expenses, all right, as a fixed cost, and we subtract from contribution margin to get operating income. So what differs here is that the fixed factory overhead is included in the cost of goods sold, whereas the fixed factory overhead or manufacturing overhead is considered as a period cost. Now, the problem happens when you are not selling all the units you produce. Then in absorption costing, only fixed factory overhead of the reported goods that are sold will be reported in the income statement. Whereas in variable costing, everything, all fixed manufacturing overhead that you incur during the period will be recorded, right, and subtracted from sales, whether you sold those units or not, right? So that's the major difference here. So you can also see visually here how the cost transfer from balance sheet to income statement or directly goes to income statement. So on the left hand side, it says all kind of costs and expenses that a company can incur. Then we have a balance sheet in the middle, then we have an income statement. And if you see that this is the asset portion of the balance sheet, and only the inventory portion I have listed here. We have material inventory, we have work in process inventory, we have finished goods inventory. So when you purchase material, it goes in material inventory until you use them. So it stays in warehouse in the material inventory. And then once you start working on the inventory, it becomes your work in process inventory. You apply labor, so direct labor is applied, you applied factory overhead. So variable and fixed factory overhead is applied. And then once you complete it, it's become finished goods inventory. And then once you sell it, it becomes cost of goods sold, which is an expense. So income statements only account for revenues and expenses. So cost of goods sold, when inventory, which was an asset initially, finished goods inventory is an asset. When you sell it, it becomes the expense or cost of goods sold. It end up in the income statement. Now, your period cost, which is selling and admin expenses, they directly go to income statement. They don't go to income balance sheet, because balance sheet only has assets, liabilities, and ownership equity accounts, right? And the sales and sales revenue and the expenses go into the income statement. So selling and admin cost, which is a period cost, directly flow to the income statement. Okay, now where variable and absorption costing differs is right here, where you see here in MOH, it says fixed MOH. So in absorption costing, fixed MOH goes to work in process, directly is going to work in process. It says here absorption costing, the red line here, absorption costing. So work in process. and then you produce the product, become finished goods, and then when you sell it, then it becomes cost of goods sold. If you don't sell it, it doesn't become a cost of goods sold. It just stays in the balance sheet. So if you produce 10 units and you incur fixed manufacturing overhead costs in those 10 units and you are unable to sell any of them, it is not going to transfer to income statement, right? Because your inventory stays in the balance sheet until you sell those inventory, right? So, but when you use variable costing, whether you sell those units or not, anything that you produce, even if you didn't sell, the fixed manufacturing overhead cost will automatically transfer to your income statement as a period cost in the period you incurred. So even if you sold 0 unit, but you incurred the cost, you are still going to subtract fixed factory overhead or fixed manufacturing overhead in your income statement from your revenues. So let's go with the example now here. Z Corporation manufactures coffee mugs. Z's variable manufacturing cost is $8 per unit, and a fixed manufacturing cost is $20 per unit per period for the whole period, right? So it's $20 is a manufacturing cost. In addition, Z incurs $10 in selling and administrative expenses. So this is a period cost is provided. And then the company produces 10 units per period and charges $15 per unit to its customers. So selling price is $15 and the company only produces 10 units in each period. So a period could be a month, could be a week, could be a year, whichever you consider. Now evaluate whether the income from operations under absorption costing and variable costing is the same under each of the following scenarios. So you need to find out whether the operating income is same under both methods or not. If Z produces and sells 10 units, it means the number of units produced is equal to the number of units sold. Or number 2, Z produces 10 units and sells 6 units, means Z produce more unit than it sells. Or Z produces 10 units and sells 13 units, means Z produces less units and it sells more units, 3 more units, means it's acquiring some units from the beginning inventory or the ending inventory from last period. Okay, so unsold units. For the above mentioned scenarios, evaluate where the fixed manufacturing costs end up, whether they end up in the finished goods inventory or they end up in the cost of goods sold. And then using absorption costing, calculate income from operations, and then calculate income from operations under variable costing. So let's start with the question. Now we have all the data we needed. So let's find out what is the manufacturing cost we have and we are dealing with. So the question says that there is an $8 variable manufacturing cost. So we are producing 10 units, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So these are 10 units at $8 each. So that's your variable manufacturing cost. And then Z incurs $20 of fixed manufacturing overhead. So it says fixed manufacturing cost is $20 per period. So $20 is fixed manufacturing cost per period. Okay, so that's the cost, the manufacturing cost data right now here. So that $20, so now we are using absorption costing. In absorption costing, that $20 is going to be allocated to the units produced. Which units have we produced? Those ones, the above mentioned, those 10 units at $8 each. So we have to allocate this. How do we allocate this? We are going to divide this 20 by those 10 units. 20 by 10 is $2 each, right? So we got $2 each. So now we are going to add these $2 to the $8 variable cost, because in absorption costing, our total cost or total manufacturing cost is equals to your variable cost and plus fixed cost. So total cost per unit would be variable cost per unit plus fixed cost per unit, which is $2, right? Remember how do we get this? We had a $20 cost and then divide by the 10 units that we produced. So that's $2 each unit. So now each unit worth $10 or the cost $10 under absorption costing. Okay. Now we move on to the variable costing. Under variable costing, these units stay separate at $8 each unit, because variable costing says what? only variable cost of goods sold is considered as a cost of goods sold. The fixed factory overhead is considered as a period cost under variable costing. So the $20 fixed manufacturing overhead will be considered as a period cost. This will not be allocated to units produced. Okay, so all fixed manufacturing overhead cost is going to stay separate as a period cost. So this is the scenario we have now. Now let's go with the scenario one. We have the number of units produced is equal to number of units sold. Okay, so what happened? We produced 10 units as the question says here, right? And we sold 10 units. So because under absorption costing, the unit cost was $10, $8 variable plus $2 fixed. So $10 times 10 is $100 transfers from finished goods inventory to cost of goods sold. Remember, when we sell, we debit cost of goods sold, we credit finished goods inventory. So the units transfer to cost of goods sold, $100, right? So now we sold 10 units. The selling price was given in the question was $15 times 10, 150, and then cost of goods sold right here, $10 times 10, which is $100. Gross profit is $50. The question also says that there is selling and admin expenses cost or the operating expenses cost at $10. So we subtract that, we get $40 operating income. That is under absorption costing. Okay, so we got $40 operating income. Now, there is no ending inventory left. Why? Because all the units that we produced, 10, we sold it. So nothing left, right? All fixed manufacturing overhead cost ends up in the cost of goods sold. So you see here, because each unit consists of the $2 of fixed cost and $8 of variable cost. So all $2 of fixed manufacturing overhead cost ends up here in cost of goods sold. Now we move on to the variable costing. Again, 10 units produced equals to 10 units sold. Now in variable costing, the cost per unit was $8 because we did not include the $2 fixed factory overhead per unit. We kept it separate, as you can see in the green T account, fixed manufacturing overhead, all $20 kept separate. All manufacturing costs are treated as a period cost. So we are not going to include this in finished goods. So then we sold all the units, so nothing left in the inventory. 8 times 10, $80 moved to cost of goods sold. Now sales stays the same because it's $15 each unit, and then times 10 units, 150, but cost of goods sold is $80. $80 because the cost per unit is $8 instead of $10 in our previous case. Right here in absorption costing was $10. In variable costing is $8 times 10, 80. So we get gross profit $70. Then we subtract operating expenses. In the previous case, if we go back here, you can see the operating expenses was $10. In variable costing, the operating expenses are $30. Why? Because the $20 of fixed manufacturing overhead is considered as an operating expense. So we add here. So now our operating income is $40. Now compare those incomes. The absorption costing income was $40. Variable costing income is also $40. That means what? That means there is no difference in the income between absorption costing and variable costing. So case number one and rule number one, when number of units produced is equal to number of units sold, then income from operations under absorption costing is going to be the same as income from operations under variable costing. So that is rule of thumb. Okay. Move on to scenario two or case two, where number of units produced is greater than number of units sold. So you produce 10 units and you sold less than 10 units. So in our example, Z Corporation produced 10 units and they sold only 6 units. Okay, so finished goods inventory. Now in absorption costing, again, the unit cost is $10, not $8. So $10 times 10 move to your finished goods inventory, and then you sold only 6 of them. So 6 times 10 moved to cost of goods sold, right? So you didn't sell all 10. So how many left? 4 units left in the ending inventory at $10 each. Ending inventory, each unit consists of $2 of fixed manufacturing overhead. because you didn't sell all the units that you produce, that means the units that you didn't sell also include the fixed manufacturing overhead cost. Okay. In cost of goods sold, you have 6 units at $10, so $60 is reported, right? That means some of the manufacturing overhead costs end up in cost of goods sold because the other ended up in the ending inventory. Remember, in variable costing, everything will go as a period cost. Here, not everything is going, okay? So sales is $15 times 6 units, because you sold 6 units, $90. Cost of goods sold is $10 per unit times 6, $60. Your gross profit is $30. Your operating expenses are only $10, right? Selling and admin. So you got $20 as an operating income. Now we move on to the variable costing. Again, number of units produced is greater than number of units sold. 10 is greater than 6. In finished goods inventory, the unit cost is $8 because we are using, again, variable costing. $2 per unit is considered as the period cost. So we only include the variable manufacturing cost, $8 times 10. Because we sold only 6 units, so 8 times 6 moved to cost of goods sold, $48. And 8 times 4, $32 are going to stay in the ending inventory in your balance sheet. Okay, all $20 are going to move to income statement because this is a period cost. Variable costing considered all fixed manufacturing overhead as a period cost. That means the ending inventory does not consist of any fixed manufacturing overhead, unlike your absorption costing, where ending inventory consists of some fixed manufacturing overhead. So your sales is $15 times 6 units, 90. Your cost of goods sold now, look at that, is $8 times 6, not 10. So 48. Gross profit is 42. You have to subtract $30 from your gross profit to get operating income. $20, all $20 from fixed factory overhead, and $10 from operating expenses. So $30. That gives you $12 operating income, which is different from your absorption costing. In absorption costing, you only subtracted $10 and your operating income was 20. Now your operating income is 12. So comparison, absorption costing operating income is $20. Variable costing operating income is $12. There is a difference. $20 minus 12 is $8 difference. Why? Why there is a difference? Because under absorption costing, 4 units stayed in the ending finished goods inventory, and each of those units contains $2 of fixed manufacturing overhead. So $2 times 4 is $8 of fixed manufacturing overhead is stayed in the ending inventory or the balance sheet, right? However, in variable costing, everything was expense. All fixed manufacturing overhead cost that you incurred during the period was expense in the period you incurred, right? So therefore, the expenses were higher. If expenses were higher, they had to report less operating income. So by $8. So rule number 2, when number of units produced is greater than number of units sold, then income from operations under absorption costing is going to be higher than income from operations under variable costing. So that was our rule of thumb number 2. Let's move on to scenario 3 or case 3, where number of units produced is less than number of units sold. This happens when you already have inventory from the prior period. You are unable to sell some units from the prior period, means you have some units in the beginning inventory of this period. Or you can also say that you have some units in the ending inventory of last period that you can use and sell them. So if you're producing 10 units and you're selling 20 units, that means you are selling 10 units from the prior period. However, in this case, right, so we are selling 13 units. The case says that the Z Corporation produces 10 units and they sell 13 units. So let's figure it out, that how is it going to look under absorption costing. In absorption costing, we had in a current period, we were producing 10 units and each unit contained $2 of fixed factory overhead. So each unit cost was $10 in the current period. In there 3 units from the prior period, each unit contains $2 of fixed factory overhead and $8 of variable manufacturing cost. So $10 each, so $30 is coming from, or $30 worth inventory is coming from the prior period. Under absorption costing, therefore, we have 3 units at $10 each from prior period, which was sitting in the beginning inventory, and $10 times 10 in this period. All 13 units are moving to cost of goods sold because we are selling 13 units. So 10 times 13, $130 are moving to cost of goods sold. There is no ending inventory left. That means manufacturing overhead cost from the prior period ends up in the some fixed manufacturing overhead costs from the prior period end up in the cost of goods sold. Why some? Because some you have probably used it in the prior period when you sold those units. Maybe you have produced 20 units in the last period and you sold 17 of them. So some of the fixed manufacturing overhead costs, you already used them when you sold those units. Okay. So now your sales is $15 times 13 units, because 3 units are from current period, from prior period, 10 from this. So that's 195. And the cost of goods sold is $10 times 13 units that you're selling, 130. Gross profit 65. Your operating expenses are only $10. This is what you have incurred during the current period. So that will give you 65 minus 10, 55 income from operations under absorption costing. Now we move on to the variable costing. As you can see here, in the current period, you have 10 units that you produce, but each unit worth $8. All right. In the prior period, you have 3 units that you didn't sell. So you're bringing that from prior period that you're going to sell during this period. Each unit has $8 cost, right? $20 is your current period fixed manufacturing cost, which is considered as a period cost. So those 20 units are for the 10 units you created during this period. That means what happens to the cost, the fixed factory overhead for these 3 units? Well, when you produce those units, you incurred during that period because you're using variable costing. So you have expensed it in that period. So we are not going to include the cost variable fixed manufacturing overhead cost for those 3 units during the current period. So under variable costing, when the number of units produced is equals to 10 and number of units sold is equal to 13. Okay, there's an error here, 14. No, this is 13. So in this case, the beginning inventory is $8 times 3 units. And then you have 10 units from the prior period. 8 times 13 moved to cost of goods sold at $104. There is no ending inventory. And then fixed factory overhead for the current period is $20. That all goes to income statement as a current period operating expenses. So your sales is $15 times 13, 195, whereas your cost of goods sold is $8 per unit times 13 units, 104. Gross profit 91, 195 minus 104, 91. And then you subtract $10 in selling and admin plus $20 of fixed manufacturing overhead for the current period. So $30 together, subtracted from 91, we get 61 in operating income. Let's see what happens. Under absorption costing, we found out our operating income was 55. Under variable costing, we found that the income from operation is $61. So there is a $6 difference. Variable costing income was more in this case. Why this happened? Why variable costing income was more and absorption costing was less? Because under variable costing, we only expensed $20 that we incurred during the current period, right? We brought 3 units from the prior period and we didn't include the fixed manufacturing overhead for those 3 units, because when we manufactured those 3 units, we have expensed the cost, fixed manufacturing overhead costs related to those units in that particular period, right? So they cost less during this period. Whereas in absorption costing, the 3 units that we brought from the prior period, they contain, each one contained $2 per unit fixed manufacturing overhead cost, right? And so we have 3 units times $2, which is $6. So the difference is $6, right? So rule of thumb is when number of units produced is less than number of units sold, then income from operations under absorption costing is going to be less than the income from operation under variable costing. Okay, so what is the conclusion? All right, so we have three cases. Case number one, when number of units produced is equal to number of units sold, then absorption costing and variable costing are going to give you same income from operations. There will be no impact on inventories because you're not going to have any ending inventories in either one. All right. When number of units produced is greater than number of units sold, then absorption costing income will give you higher income from operation than variable costing income, and the inventories will increase. Why? Because you are expensing out everything in the variable costing, whereas in absorption costing you are not expensing out everything. You didn't sell, and the units that you didn't sell will contain fixed manufacturing overhead, which will bump up the inventories, right? Cost. In case number three, when number of units produced is less than number of units sold, then the absorption costing operating income will be less than variable costing income, and the inventories decrease because now you're using the previous period units and selling them in this period, those units that contains the fixed manufacturing overhead in them, right, under absorption costing. So that means your inventories will decrease when you take those units out and sell them with the current period units. And that completes the differences between absorption and variable costing. Thank you for watching my video. Please subscribe my channel for live updates.